In 1715, a Spanish treasure fleet carrying 14 million pesos in silver sank off the Florida coast during a hurricane. 11 ships. 7 million pieces of 8. Enough precious metal to fund entire wars. 3 centuries later, J.P. Morgan Chase processes $5 trillion in transactions daily through clearinghouse systems that operate on the same principles pirates used to launder stolen Spanish gold. The methods changed. The mathematics didn't. This is another video where money, power, and history collide, and nothing is ever as simple as it looks. Most people think pirate treasure belongs in museums or adventure films. Doubloons and pieces of 8 represent a romantic past where criminals sailed wooden ships and buried chests on tropical islands. The popular imagination sees piracy as primitive banditry that ended with the golden age of sail. That version misses the point entirely. Pirates weren't just thieves. They created the world's first truly global money laundering network. They invented offshore banking. They established the template for every financial haven that exists today, from the Cayman Islands to Singapore to Switzerland. Between 1650 and 1730, an estimated 2,500 pirates operated across the Atlantic, Pacific, and Indian Oceans. They didn't just steal treasure. They built a parallel financial system that moved wealth across continents, converted stolen goods into legitimate commerce, and corrupted governments on 4 different continents. The Spanish Empire extracted roughly 150,000 tons of silver from the Americas between 1500 and 1800. 1/3 of that silver never reached Spain. Pirates intercepted some of it. Corrupt colonial officials diverted more. But the largest portion disappeared into what historians now recognize as the world's first shadow banking system. Henry Morgan understood this better than most. The Welsh privateer, who became Lieutenant Governor of Jamaica, didn't retire to count his coins. He established a network of merchants, bankers, and government officials that transformed stolen Spanish silver into legitimate British commerce. Morgan's system worked like a massive washing machine for dirty money. Stolen silver entered the network in Port Royal, Jamaica. Corrupt merchants issued bills of exchange that converted physical treasure into paper credit. These bills traveled to London, Amsterdam, and Boston, where legitimate banks honored them without asking questions. The silver itself got melted down, refined, and minted into British, Dutch, or American currency. The process required corruption at every level. Colonial governors received shares of pirate profits in exchange for protection. Merchants provided false documentation that made stolen goods appear legitimate. Bankers in European capitals processed transactions without examining their origins. It was like letting students grade their own exams. The people who benefited from the system also controlled its oversight. Captain William Kidd's trial in 1701 exposed how deeply this corruption penetrated British society. Kidd claimed he operated under orders from Lord Bellomont, the governor of New York. His backers included some of the most powerful figures in British politics and finance. When Kidd threatened to reveal their involvement, they abandoned him. The British government executed Kidd for piracy. They never prosecuted his financial backers. The system protected itself by sacrificing its most visible operators while preserving its hidden infrastructure. This pattern repeated across the Caribbean. Pirates like Blackbeard and Bartholomew Roberts served as the violent face of operations that extended deep into legitimate commerce and government. When public pressure demanded action, authorities eliminated individual pirates while leaving their financial networks intact. The real innovation wasn't violence. It was opacity. Pirates created the first truly international system for moving money without leaving paper trails. They established correspondent relationships between criminal organizations and legitimate businesses. They pioneered the use of neutral territories where different legal systems created regulatory gaps. Madagascar became the Cayman Islands of the 17th century. The island sat outside European colonial control, but maintained trade relationships with merchants in India, Arabia, and America. Pirates could convert stolen goods into legal commerce by routing transactions through Madagascan intermediaries. Thomas too demonstrated this system's sophistication. The Rhode Island native operated in the Indian Ocean, where he captured Muslim pilgrimage ships carrying enormous wealth to Mecca. Rather than burying his treasure, Too established relationships with merchants in Bombay and Calcutta who converted his stolen goods into legitimate trade. The wealth flowed back to Newport and New York through established commercial channels. Too's investors included prominent American merchants who used pirate profits to fund the colonial economy. The money that built early American fortunes often started in the holds of captured ships. The system's collapse came not from law enforcement, but from economic evolution. The War of Spanish Succession ended in 1713, eliminating the legal framework that allowed pirates to operate as privateers. The Royal Navy's dominance made piracy increasingly dangerous. Most importantly, legitimate international trade became more profitable than theft. Pirates had succeeded too well. The global financial networks they created to launder stolen wealth became more valuable than piracy itself. The merchants, bankers, and officials who profited from pirate money discovered they could make similar fortunes through legal international commerce. The infrastructure remained. Only the source of money changed. Modern offshore banking operates on principles pirates established 3 centuries ago. Wealth enters the system in jurisdictions with weak oversight. Shell companies and complex ownership structures obscure its origins. The money emerges in major financial centers as apparently legitimate capital. The Cayman Islands processes more banking transactions than any country except the United States and United Kingdom. Switzerland manages roughly $2.4 trillion in offshore assets. Singapore has become Asia's primary financial haven. These jurisdictions serve the same function Madagascar did for pirates. They provide neutral territory where different legal systems create gaps in oversight. Cryptocurrency has digitized techniques pirates perfected with physical silver. Bitcoin transactions move wealth across borders without traditional banking oversight. Decentralized exchanges allow users to convert between currencies without revealing their identities. The technology changes. The underlying mathematics remain identical. The names have changed. The behavior hasn't. Modern financial crime operates through the same networks of legitimate businesses, corrupt officials, and regulatory gaps that pirates created. The scale has grown exponentially, but the structure remains recognizable. Russian oligarchs, Mexican cartels, and African kleptocrats all use variations of Henry Morgan's model. Stolen wealth enters the legitimate financial system through shell companies and offshore accounts. Corrupt banks process transactions without examining their origins. The money emerges in London, New York, or Hong Kong as apparently clean capital. Even the violence has become more sophisticated. Modern financial criminals rarely need cutlasses when they can achieve the same results through regulatory capture and political corruption. They don't need to sink ships when they can simply buy the ports. Pirates didn't invent financial crime. They simply globalized it. The treasure they buried wasn't gold and silver hidden on remote islands. It was a system for moving dirty money that became the foundation of modern international finance. Every offshore account, every shell company, every financial haven traces its ancestry back to those wooden ships flying black flags in Caribbean waters. The greatest pirate treasure was never found because it was never lost. It just learned to wear a suit.